Welcome to Honest Money. In today's episode, Warren Ingram answers your questions around life policies and the benefits in terms of monthly installments, interest rates, and whether it's better to contribute to an RA instead. Warren also explains how compound interest works in investments like the Satrix Top 40. Keep listening for more.
Hi Warren, I trust you're keeping well. So the question is around my dad's current life insurance policy. My dad is 57 years old and currently has a life insurance policy which is quite costly every month and comprises about 13% of net monthly income. In addition, the policy costs increase 12.5% per year, and I simply do not see it being affordable in the next 5 to 10 years, even with a monthly income. In addition, the actual lump sum payout of the policy only increases between 3 to 4% per annum. Some background information. My dad has no debt, no vehicle finance, no mortgage with a house paid off, and no credit card debt. He maxes out his tax-free savings account annually to the $36,000 annual limit. He has a retirement annuity and other long-term investments that he makes consistent monthly contributions towards. Myself and my sibling are both qualified and have professional corporate jobs. My mother doesn't work, so that's from a dependent side. So my question to you is, does my dad still need this life policy? My thinking was to stop the life policy and rather invest the same amount into another investment or increase the contribution to the retirement annuity to get a greater tax deduction. All things being equal, over 20 years, I suspect the value of the investment will be greater than or equal to the life policy payout. I know there are a lot of caveats to this question and there are no guarantees on the investment performance and the predictability of death, but I thought you could maybe give me some additional insight or points to consider. Thanks, Warren. Really appreciate it.
Life assurance is such a tricky and emotive topic, so it is something that we have to focus on and talk about a lot when we're on our financial planning journey. And I think with your father, it is an interesting situation. So let me give you my principles about life cover, when you need it and maybe when you don't need it. And the first thing is you earmarked a very critical point. If you've got debt, and it doesn't matter what the debt is, if it's credit cards, personal loans, car or mortgages or anything, anything like that, you need to make sure that those debts can be paid off if you pass away. And certainly that the people who are financially dependent on you are not in a worse off position because you've died and left them with a big problem, a big financial hole. So having life cover to cover your debts makes sense to me. The second reason that you need life cover is let's assume like your father that there is no debt. Then you also want to make sure that there is enough investment money left behind to look after your mom or any other financial dependents that someone could have in a situation like this. So if someone's got enough investment assets that would cover their normal lifestyle expenses if they were to pass away and their family can then live without a big change in lifestyle, then you can get to the point where you cancel your life assurance and make sure that the family is taken care of. It is a complicated situation. As you say, there are lots of caveats. So I'm certainly not going to cover all of them. And the life assurance salesman would also want to point out that you need to make sure that things like executors' fees and any estate duty that might be payable needs to be covered as well. And yes, there are lots of other factors to consider. But the main principles for me would always be make sure that you've got sufficient life cover to get you out of debt, and then additional life cover to complement the investment assets that you've got so that your beneficiaries are not compromised financially if something happens to the breadwinner. So those are the key principles. If you're in a position like your father where he's in his 50s, he's got life cover, it's maybe an old policy and it's going up at that kind of a rate of 12% or 12.5% a year, then one immediate thing I would be doing is I wouldn't cancel that cover straight away. I would shop around. I would try and get at least 3 different quotes from 3 different insurance companies and see what life cover your dad could get at a lower premium, because often the older policies are not as efficient as the newer policies. The underwriting requirements are a bit better nowadays, and life companies have certainly evolved and made life cover a bit more appropriate. So you might find that, your dad could say, get better life cover at a better rate, even though he's a bit older than when he first took out the policy. So shopping around makes a lot of sense. What I would say is, if you're going to deal with insurance agents, tell each of them that you are going to get a quote from the other company, and then ask them to look at all three quotes. Get each one to look at the quotes and explain why theirs is better or worse than the competitors. And once you've done an exercise like that, and you've got three separate insurance agents that are well trained in their products and often well trained in their competitors' products, you've got a very good idea whether your father is going to be okay or whether he can get better life cover. It's also important to make sure that medically he's in a decent condition to get life cover. Often life insurance companies will say for older people that maybe have developed a bit of high blood pressure or hypertension or a chronic illness. Even if it's not at advanced stages, they'll just say, either we won't cover your father if he dies at all, or we'll insure him, but we won't insure him against these, anything to do with high blood pressure or something. In which case, it might be better to stay with the existing policy that he's got. But I would say understand the size of investment assets that he already has. And if those investment assets are sufficient to look after your mom for the rest of her life, and he doesn't have any debt, and the executor's fees will be paid, then it might be worth looking at that life cover story differently. But definitely you want to do your homework. Definitely want to get some quotes and understand the whole position before you take the step of just cancelling the cover. Good luck with your moves forward.
Hi Warren, thanks for the great show. Can you please explain how compound interest works with shares? I don't really understand it. It seems a bit counterintuitive. I understand with a bank account, the first month you earn interest and then you earn interest on interest. But with a share portfolio, so like a Satrix top 40, you're not really earning interest. You're earning growth. So it's just the growth of the shares and the paying of the dividends that you keep reinvesting. So how does compound interest per se work with that type of thing? Thank you.
Compound growth or compounding or compound interest is a really key ingredient in a successful long-term investment strategy. And I think it is worth spending time on to understand it and to understand how it works. So I think it's a question a lot of people will be holding, and I appreciate you asking it. So maybe just to start, I think when we talk about compounding, there are different forms of compounding. And so your example of a bank account where let's say you put 1,000 Rand in, and every month that 1,000 Rand earns 1 Rand of interest, and that 1 Rand gets added to the 1,000 Rand. So the next month you've got 1,001 Rand earning a little bit more interest. And so as time goes on, the interest gets added to the bigger amount, and so all of that attracts more interest. And by the end of the year, let's say you've got 1,012 Rand, and you're earning 1 Rand and let's say 12 cents for argument's sake as interest every month. And that's the power of compound interest. But when we talk about buying shares, we're still talking about compounding and compound growth, but we're just not talking about compound interest. So what happens with shares is there are two main ways that you're going to earn money from investing in a share or an index. The first is the change of the price of that investment. In other words, you buy it for 1 Rand, and it goes up. By the end of the year, it's sitting at 1 Rand 10, and a year later, it's at 1 Rand 20, and so you go. And so that change of price is a very important way of generating growth. But the other part of it is companies that pay a dividend. So let's say you buy your share at 10 Rand, and you earn 1 Rand through the year of dividends. So that's a little bit like earning interest on a bank account. So you can then use that 1 Rand to buy more shares, and then you're getting the capital growth as well. So compounding, it's about leaving the money in an investment for a long period of time and letting it grow on itself. And it's not about trying to get a great return over a day or a week. It's about very much around the long-term the long-term growth of money making money babies, I guess. So you're right to say it's not compound interest when you buy shares, but it certainly is still compounding. There's a quote that says compounding is the 8th wonder of the world, and certainly I believe that. So yes, you should allow your share or ETF investments to stay invested for long periods of time to get the benefit of that compounding of the share price, but also whatever dividends you earn, make sure that those are also reinvested, because over time the compound effect of the dividends that are reinvested will account for about half of your growth from a stock market portfolio. So it's a really key number, and it's a key thing to focus on. Hope that helps. Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @Warren Ingram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.